Adjusting journal entries are the heart and soul of a month-end close. So today, we're gonna go over 10 of the most common adjusting journal entries that you'll make. But first, what exactly is a journal entry? Recall that debits and credits help you indicate whether an account on your general ledger is either increasing or decreasing. And different accounts have different rules for when debit and credit means increase or decrease. Debits must always equal credits, no exceptions. And you can remember how they work by just memorizing the fact that assets go up with a debit and down with a credit. Once you know that, you'll know that the right side of the accounting equation behaves in the exact opposite manner. So liabilities and owner's equity, well, those go up with a credit and down with a debit. And because your profit and loss flows into your owner's equity via an account called retained earnings, any accounts that make your owner's equity balance go up will also go up with a credit and down with a debit, just like owner's equity. So examples of those are revenue and other income accounts. Now, if we have an account that makes your owner's equity balance go down, well, then that behaves in the opposite way. So cost of goods sold, operating expenses, other expenses, those all go up with a debit and down with a credit. Now, I'll link to a full video below on how debits and credits work, but now you have a basic refresher. So a journal entry is a record of both a debit and a credit recorded to adjust the values in your general ledger. One journal entry can have just one debit and credit, or it can have multiple. But keep in mind that under the accrual basis of accounting, you'll be posting a lot more journal entries than under the cash basis of accounting. That's because the accrual basis is concerned about what is actually taking place in the business in terms of activity. Revenue goes up when it's earned. Expenses go up whenever they're consumed or incurred. The cash basis, well, it's a lot simpler. For the most part, you just treat all the cash received as income and all the cash spent as expenses, regardless of when you actually earn your income or consume that expense. I'll link to a full video on that below as well. And today, we'll assume that we're using the accrual basis of accounting, which is good because the cash basis isn't compliant with generally accepted accounting principles. So now let's go over 10 common adjusting journal entries, starting with what I think is the most popular journal entry, prepaid expenses. A prepaid expense is an expense that you have paid for, but you haven't yet consumed. So let's say you buy tickets to a conference in 3 months from now. Until you actually go to that conference, you're not going to recognize that expense on your profit and loss. You haven't yet consumed that benefit. So instead, you'll have an asset called prepaid expenses. You'll debit prepaid expenses since it's an asset, and you'll credit cash since that's another asset. When you then go to the conference in 3 months, you'll debit an expense account like conferences, and then you'll credit prepaid expenses. Journal entry number 2, deferred revenue. Deferred revenue is also a really popular one, and that represents the dollar amount of goods or services that you owe to your customers. Now, most of the time, that would be whenever a customer prepays for something that they have not yet received. The opposite of a prepaid expense, which when you are the customer, you prepaid. But it's possible that it could actually arise if there is an unconditional obligation for them to pay. So when you send an invoice, that invoice becomes due. So let's say you run a software service and you sell subscriptions for a 12-month period. If a customer prepays for all 12 months or owes you money to their subscription, you would debit the asset account, in this case cash or accounts receivable, and then you would credit deferred revenue, which is a liability, since it's something that you owe. Remember, liabilities go up with a credit and down with a debit. Each month, as you then deliver your software service to your customer, you'll take 1/12 of the contract value from your deferred revenue balance, remove it, and place it into revenue on your income statement. That will happen by debiting deferred revenue to make it go down and crediting revenue to make it go up. All right, let's go over example number 3. But before I do, hey, nice to meet you. I'm Josh, your CFO guy, and I help people like you grow in your career with fun and exciting videos around finance and accounting. Go ahead and hit that subscribe button if you aren't already subscribed, and don't be shy with that like button. Back to journal entry number 3, accrued expenses. Accrued expenses are expenses that you have incurred but not yet paid. But if you already have a bill from a vendor related to this expense, you'll usually classify that as accounts payable. So for that reason, accrued expenses is oftentimes used for expenses that have been consumed, but you haven't yet actually received a bill. Okay, so let's go over an example. Say you hired a fractional CFO. Hey, how you doing? Your fractional CFO did some amazing work for you and offered you advice that has been such a game changer in your business this month. When the month ends, if you don't receive a bill yet from your fractional CFO, you don't have to wait to close your books until you do. Instead, you can book an accrual. So you estimate that the cost will come out to about $1,000. So you'll debit consulting fees or accounting fees, and you'll credit accrued expenses. Now, in a few days, you'll receive a bill from your fractional CFO, but your books may already be closed and locked. So here's where things get a bit tricky. When that bill comes in, you'll classify that bill in the next month as you normally would for a bill. Debit consulting fees, credit accounts payable. You'll then reverse the journal entry from last month. So you'll debit accrued expenses and you'll credit consulting fees. The end result is that you'll be left with a consulting fee in 1 month and an accounts payable balance in another month. If you estimated correctly, way to go. If not, that's okay too. It would just mean that you over accrued or under accrued, which is totally acceptable, which is similar to another journal entry, accrued interest. See, if you take out a loan, you'll get charged interest, but you may not have to pay that interest right away. Instead, it may accrue. So you'll debit interest expense and you'll credit accrued interest. When you actually make the payment, you'll debit accrued interest and credit cash, which reminds me of one more entry, accrued payroll. Most companies run payroll twice a month, and when that happens, you may get charged, let's say, a day after the month ends. Or maybe you run payroll every other week, which means you need to adjust your actual expense in your books for the correct amount for that month. Under either situation, you'll debit payroll expense and you'll credit accrued payroll. When the money then actually hits your account, you'll debit accrued payroll and you'll credit cash. All right, number 6, inventory. Inventory represents the amount of goods that you have on hand to sell to customers. Now, that inventory can be at different stages of production, most commonly broken out by raw materials, work in process, or finished goods. Those are all pretty much what they sound like. Raw materials is like the nuts and bolts before you do anything with that. Work in process is when you start assembling them together, but your product is not fully ready. And finished goods is finished goods. So when you buy raw materials, you'll debit raw materials and you'll credit cash. When you convert something from raw materials to work in process, you'll debit work in process and credit raw materials. When you convert something from work in process to finished goods, you'll debit finished goods and credit work in process. Okay, now here's the key. When you finally sell that finished good to a customer, you'll record a debit to your cost of goods sold, which is the cost of your goods sold. You'll then credit finished goods from your inventory. All right, nicely done. But we got 3 more. Stay with me. Okay, I'll hand you an easy one. Security deposits. When you rent an office space, your landlord is going to want to collect a deposit. And if you, let's say, play beer pong and ruin your floors, well, your landlord will then keep that deposit. True story, that actually happened to me in college and I lost my security deposit. But when you pay the security deposit, you'll debit security deposit and you'll credit cash. When you then get back that security deposit, you'll debit cash and you'll credit your security deposit. And if you don't receive back your full amount, you'll debit an expense like beer pong expense. Maybe that's actually not a good account to show on your chart of accounts. Number 8, intercompany balances. So when you have one company that owns another company, own you, bro. Then you need to perform what's known as a consolidation between these two entities. Now, there are a ton of rules for when you need to consolidate and how to consolidate your books that honestly, I don't even recall from the CPA exam. But if you want me to make a video on that, just let me know in the comments below. So before you consolidate, each set of books will record an intercompany balance. So let's say company A pays $1,000 to an employee that actually belongs to company B. Well, company A isn't going to record an expense since it's not an expense of company A. Instead, they'll debit an asset account called due from subsidiary or parents, depending on who company A and company B is, and then company A will credit cash for the amount paid. Company B, well, this time they're the ones who are going to record the expense. So they'll debit payroll expense for $1,000, and this time we'll credit a liability called due to parent. When the two companies then consolidate, the due to and the due from cancels each other out. Okay, now we get to our last 2 entries. and these are similar to one another. Depreciation and amortization. Depreciation represents the wear and tear of your fixed assets. So when you buy a piece of equipment, you'll debit the value of the equipment and you'll credit cash. But that equipment can't remain on your assets forever. Eventually, it'll degrade in value, and we show that reduction in value by recording what's known as depreciation expense. Now, you can depreciate using a number of methods, straight line or double declining or makers, but we'll use straight line in this example. So let's say your equipment has a useful life of 5 years. Each year, you'll take 1/5 of your equipment's purchase price, debit depreciation expense, and credit accumulated depreciation. That accumulated depreciation is what's called a contra account. It sits as an offset to the section it's in this case, a contra asset. So you'll just show the net balance of your fixed assets with this contra asset canceling out the purchase price. Now, you may also have a salvage value, which is the amount that you can sell this equipment for scraps whenever you're done. If so, just take your fixed asset purchase price less the salvage value and then divide it by the useful life. Man, there's so much more to share about fixed assets. Just let me know in the comments below if you want me to make a video on that. But before you do, let's cover our final adjusting journal entry, amortization. Let me just tell you, if you know what amortization means, you instantly sound cooler. Yo, you want to amortize tonight? Amortization is just like depreciation, only it's for intangible assets. These are assets that exist, but you can't see them, like aliens circling around in our universe. A common intangible asset will be like a patent. Patents have useful lives, so you'll reduce the value of those patents by amortizing it. Debit amortization expense and credit accumulated amortization. And just like accumulated depreciation, accumulated amortization is a contra asset. It'll offset the value of your intangible assets. And there you have it. But to really master your adjusting journal entries, you need to understand how the financial statements are connected. And this video right here, it'll walk you through all of those details from start to finish. But in the meanwhile, what's your favorite adjusting journal entry? Let me know in the comments below, and I'll catch you in the next video.